Greetings to all of you from KPMG. Ashok Hariharan, Head of Tax for KPMG in Oman, and the moderator for today's webinar. Finally, the uncertainty on the implementation date of VAT in Oman is over. The royal decree issuing the VAT law was published 2 days back. I'm glad that you found time to join us for this webinar, which will provide insights on the law issued. Before I begin, as usual, a few administrative matters. You may send your questions through the Q&A tab on the right. We will address them during the Q&A session. After the webinar, please take a minute to complete the survey. Your comments are valuable to us. Finally, a note to say that we are recording this session. Let's look at the agenda for the webinar. After my introduction, Aabha Lekhak, our VAT leader for Oman, will take us through the key provisions of the Oman VAT law. She will discuss the issues that would need to be addressed by businesses as they deal with the necessary organizational and IT changes even ahead of the issue of the detailed executive regulations. Nick Soverall, our Saudi head of indirect tax, and Reese Penning, our UAE head of indirect tax, will discuss some key differences between the Oman and the Saudi UAE laws that may be relevant for us to know. We will round off our webinar by identifying the next immediate steps for businesses to take. A few comments from my side. As you may know, the go live date for VAT is 16th April 2020, a Friday. I had indicated last month in our webinar that the VAT law, in my view, is imminent with a likely effective date of April 21. I am not surprised that this has turned out to be true. It's been a long journey for Oman. We were engaged 12 years ago to assist them in designing a VAT system. I'm glad that our long association with the tax authority has finally come to fruition. The VAT law is in line with the GCC framework agreement and the laws issued in other countries, with some differences. As expected, the law does not contain the detailed rules, which are important and will come later in the form of executive regulations. Interestingly, and this will be a concern to all, the law allows the tax authority time of up to 6 months after the implementation date to have the executive regulations in place. That could mean October 21. I did speak to the senior officials of the tax authority on the very day the law was issued, and they assured me that every effort will be made to issue the executive regulations as soon as possible, possibly even by the end of this year. That may be a bit optimistic, but we should certainly be expecting implementation guides to be issued periodically, which will provide some much needed guidance. We know that the tax authority is taking inputs from certain stakeholders in finalizing the executive regulations, and we are providing our inputs. Let me, however, tell you, looking at the experience of businesses in the region, that it will not be prudent to wait for the executive regulations to be issued to start getting ready for VAT. That will be too late. The time to act is now. The clock has started ticking. Aabha, over to you. We are keen to get your insights on the Oman VAT law.
Thanks, Ashok. Good morning, everybody. So over the next few slides, we'll walk you through some of the key provisions of the Oman VAT law. This is not a detailed technical session, and in the interest of time, we don't intend to deep dive into the provisions or the contentious issue. The objective of this session is to allow you an overview of the proposed VAT regime in Oman. So if we can move to the next slide. Now, the GCC Common VAT Agreement is the overarching agreement that sets out the framework for VAT in the region. The VAT laws in the KSA, UAE, and Bahrain largely mirror the GCC Common VAT Agreement, and Oman is no different. With 13 chapters comprising 106 articles, the Oman VAT law contains provisions on the definitions, scope of levy, goods, services deemed supplies, provisions regarding place, time, and value of supply, compliance-related provisions. It also gives us some certainty around supplies that would qualify for exemptions, zero rating, suspensions. The details, of course, would follow in the executive regulations. And of course, any law would be incomplete without provisions around penalties and dispute resolutions. So the law also covers those aspects. Moving on to the next slides. Couple of things that stand out immediately when you look at the law are the provisions around the effective date and the executive regulations, which Ashok also mentioned earlier. The provisions are not unusual in themselves, but their potential consequences. For instance, the law is made effective 180 days from date of publication, which works out to 16th of April 2021, and as Ashok pointed out, a Friday. VAT is a transaction tax. It does not necessarily need to follow an annual, monthly, or a quarterly start date. But to introduce VAT in the middle of a month would only mean more planning around cutover and transition for businesses. Now, on the executive regulations, the Oman VAT law allows the tax authority up to 6 months after the effective date, which means up to October 2021 to issue the executive regulations. Again, Ashok mentioned earlier that the tax authority is aiming to publish the executive regulations by January 2021, and in the absence of executive regulations, is certainly trying to roll out guides for businesses to have enough guidance to prepare for VAT implementation. But I'm personally still reeling from the experience of excise tax implementation in Oman, where the law was made effective on 15th June 2019. It had a similar provision allowing the tax authority 6 months after the effective date to issue the executive regulations. So ideally, the executive regulations for excise tax should have been published by 15th of December 2019. But in fact, they were published in July 2020, whereas the law took effect and excise tax was imposed from 15th of June 2019. So given the timelines, businesses cannot wait for the executive regulations to start their preparation for VAT implementation. It will be too late. On the scope of the levy, the law is aligned with the GCC Common VAT Agreement. It provides for levy of VAT by a VAT registered person on supply of goods and services at a standard rate of 5%, unless the supply is specifically exempt, zero rated, suspended, or out of scope. It also provides for levy of VAT on import of goods and services and transactions qualifying as deemed supply. So let's look at the exemptions, zero rating, and suspensions in the VAT law. Currently, the VAT law exempts financial services, healthcare services, and services and goods related to healthcare services, education services, bare land, resale or lease of residential properties, and local passenger transport. Of course, the scope of each of these would have to be fleshed out in the executive regulations for us to understand what would be exempt and what would be taxable. But what immediately stands out, if we look at residential properties, it refers to resale or lease. So the question that warrants consideration over here is, what happens to the first supply of residential properties? It is neither specifically exempt and it is neither zero rated. So by logic, that would mean that the first supply of residential properties in all likelihood would be standard rated and liable to tax at 5%. Moving on to the provisions of zero rating, these are broadly classified in two categories. One, zero rating for supplies which are made within Oman, and the other zero rating for supplies which are made outside the GCC, but until all countries are identified as implementing states, let's refer to it as outside Oman. When we look at zero rating for supplies within Oman, we have a zero rating for supply of crude oil, oil derivatives, and natural gas. Given practical experience we've had in the UAE and KSA, it will be critical that the VAT executive regulations clearly define the scope of crude oil, oil derivatives, and natural gas. Now, the zero rating is also extended to certain specified food items, medicines, and medical equipments. We do not expect the list of these products to come out in the executive regulations, given how it's panned out in the rest of the region, specifically Bahrain most recently. We would expect this would be by way of a separate notification or decision of the tax authority. Now, within zero rating, we also have international transport of goods or passengers, as well as supply of services in connection with such transport. And it will be important that the executive regulations define the scope of services in connection to such transport so that logistics service providers, port operators are able to ascertain the extent of zero rating that they would be eligible for. Moving on to the zero rating for supplies outside Oman, this includes the usual transactions of export of goods, export of services. It also provides for zero rating where goods or services which when supplied in Oman would be exempt. If they're supplied overseas, they would be entitled to a zero rating. For instance, financial services, if they were provided within Oman, they would be exempt. But if these were provided outside Oman, they would be zero rated. Moving on to suspensions, the VAT law also recognizes certain transactions or certain scenarios where the imposition or the levy of VAT would be suspended. These are essentially around import of goods under a specific custom suspension, but these have also been extended to transactions concerning special economic zone. Now, when we say special economic zone would also extend to free zones to the extent such areas fulfill the criteria which will be set out in the executive regulations. But essentially, the suspension applies to supply of goods and services to and from special economic zones and free zones, as well as supply of goods within special economic zones and free zones. In addition to this, the law also defines certain transactions which are considered as out of scope for the purposes of VAT. These include transfer of business or an independent part of a business as a going concern. Of course, there would have to be additional guidance on what are the criteria a business needs to satisfy for the transaction to be called as transfer of business on a going concern basis. It also includes settlement of insurance claims under certain circumstances, as well as transactions between members of a VAT group, but this does not apply where the transaction is that of a deemed supply, which takes me to the next slide on deemed supplies. Now,
Aabha, sorry, can I just pause you there? Your statement on the zero rating and the treatment of special economic zones is very significant. So this must be quite good news for people in the free zones and special economic zones.
Certainly, and I think what we would need to look at is first, we would expect that the executive regulations set out what qualifies as a special economic zone or free zone. I don't think we can take it for granted that if for the purposes of customs or another royal decree, a particular territory qualifies as a free zone or a special economic zone, it would also be entitled for this suspension, which implies zero rating for the purposes of VAT. So businesses would have to be cautious of that. But yes, this certainly does give an advantage to businesses who are set up in special economic zones and free zones, and also business who are looking at setting up their operations, because it allows you to manage your cash flows much more effectively because of the zero rate that comes out of the suspension.
Yeah, I think the interesting and significant point is that it also covers services to and within the special economic zones. Thank you.
Sure. When we're looking at services, of course, place of supply rules would be critical. Not all services would qualify for the suspension or zero rating. Now on to deemed supplies. What are deemed supplies? Now, deemed supplies are transactions which, in common parlance, for the purpose, do not have a consideration attached and therefore do not qualify as the conventional supplies for the purposes of VAT. But the VAT law makes exceptions and identifies these transactions and therefore brings them within the scope or web of VAT. Deemed supplies presumes that the business has claimed or recovered input tax on goods or services which are related to such supplies. But in usual course of business, these transactions would essentially involve supply of goods or services without considerations. So samples, free gifts, certain incentives or fringe benefits we even extend to employees could get caught under this. The law does make an exception for distribution of commercial samples and gifts, but we, we presume that the executive regulations will certainly put a monetary cap on that. Other examples of deemed supply include changing the use of goods to make exempt supplies, changing the use of goods to use them for non-business purposes, retention of goods after discontinuation of business or after deregistration. With that, we'll move on to the next slide on imports. As I mentioned earlier, import of goods and services into Oman will also be subject to Oman VAT, and that would be under the reverse charge, where the liability to pay import VAT would be that of the recipient business in Oman. Now, in case of import of goods, the law does provide for payment of VAT at the time of customs clearance, which means that this could have an impact on the working capital for businesses. But the law also allows importers the option to request for a deferral of payment of VAT from the time of customs clearance to the time of filing the return. In order for businesses to exercise this option, in addition to applying to the tax authority, they would also have to submit financial guarantees securing the payment of VAT. The law also exempts certain imports from the payment of import VAT. Just to quickly touch upon some of them, the import of goods which would otherwise be exempt or zero rated if they were supplied in Oman, they're exempt from import VAT. Return goods. So when you make a sale to a customer overseas and the goods are being brought back, they would not be liable to import VAT. And imports by certain bodies, which is armed forces, internal security forces, military, charitable organizations, diplomatic and consular bodies, international organizations. In addition to this, there are also certain exemptions which have been extended to personal effects as well as goods which are brought for people with special needs. With that, we move on to the next slide on place of supply rules. Now, the place of supply rules help you ascertain where a transaction is deemed to have taken place. And that's very critical given that VAT is a consumption or a destination-based tax, because that then ascertains the state's or the country's jurisdiction to levy tax on such a transaction. The place of supply rules under the Oman VAT law are largely in line with the GCC Common VAT Agreement. So you can see that there are separate place of supply rules set out for supply of goods with transport, without transport. There is an exception which is carved out for supply of oil, gas, and water through pipeline and electricity. So far as supply of services is concerned, there is the general rule, and there's a carve out or exception made for special transactions or special cases which involve transactions or services related to real estate. There are restaurant, cultural, or sporting event related services, services in relation to transportation of goods and passengers. What stands out over here is the place of supply in relation to telecommunication and electronically supplied services. Now, when it says telecommunication and electronically supplied services, the scope of this, of course, would be defined in the executive regulations, but the place of supply in case of these transactions is where the services are actually used and enjoyed. But what the law does not define is how do you ascertain where these services were actually used or enjoyed. And we would expect that the executive regulations will define what the place of actual use or enjoyment is. Is it the place of residence of the customer, like some countries in the region have adopted? Is it the place where the SIM card for the telecommunication services was obtained? Or is it the actual physical place where the services were used in enjoyment, which could be a little challenging to track? With that, we move on to the next slide on time of supply. Now, the time of supply provisions help you ascertain at what point in time your VAT obligation on a particular transaction arises. Again, these provisions are also in line with the GCC framework agreement as well as most neighboring countries. The general rule, if you see, is that the obligation to pay tax on a transaction arises on the earliest of the date of supply, the date of issuance of the tax invoice for the supply, or the date of receipt of payment. Now, the third has an impact on advances, not just the closing balance of advances, but also advances that you would recover in the future, because these could become liable to VAT upfront and therefore will require some planning around the working capital that you would need to pay taxes on these advances on. A distinction is made for continuous supply. When we say continuous supply, it essentially refers to contracts which are long-term and provide for periodic or consecutive billing. And in such cases, the point of taxation or the time of supply, which is when the VAT obligation arises, is either the date of receipt of payment or the date of receipt of payment or date of payment specified in the invoice. The law does call out that there will be special provisions made for ascertaining the time of supply in case of supply of prepaid calling cards and vouchers. And this will be critical because vouchers can be a little complicated in the sense that you could have single purpose vouchers which could be used only for one type of supply. You could have multi-purpose vouchers. Vouchers could move directly from the issuer to the end customer or could go through a supply chain which involves multiple intermediaries. The executive regulations will have to set out clear guidelines because this will impact multiple industries, retail, consumer, food and beverages, as well as the telecom sector. Moving on to the next slide on value of supply. Again, largely in line with the GCC framework agreement, these provisions around value of supply help us ascertain what is the tax base, what is the value a business should be charging VAT on. And essentially, it starts with charging VAT on the consideration. When we say consideration, it's not just the monetary consideration, but also any non-monetary consideration that you may receive in exchange for the supply of certain goods or services. And it also requires businesses to add any expenses or reimbursements that they would have recovered or recouped from their customers in the course of making these supplies in the tax base and offer it to VAT. It allows for certain deductions, essentially discounts, subsidies, grants, but it is extremely important that each of these is looked at carefully for us to see whether a deduction is really eligible or not. For instance, subsidies and grants could have a different connotation for the purposes of VAT, and the fine print of the subsidies and grants will have to be looked at carefully to make sure that this is in essence a grant and not an indirect consideration for the supplier. There are also special provisions around the valuation of related party transactions, and the law says that where transactions between related parties are below the market value, the executive regulations will help establish on how to ascertain the market value, and these transactions would then be subject to tax at the market value and not the actual value. Usually, we would see such provisions being made only in instances where the recipient of goods or services is not in a position to claim input tax credit on the supply. But the Oman VAT law doesn't seem to be making that distinction. Therefore, it will be important that businesses look at intercompany transactions, intergroup transactions to make sure that valuations are set right. And this is only the stepping stone. With us moving closer to transfer pricing and other regulations, this will be critical for us to look at right now to make sure that indirect taxes are aligned with corporate taxes as well as transfer pricing. So far as deemed supplies are concerned, as I mentioned earlier, there is no consideration that you receive in exchange for the deemed supplies. So how do you value these? And the law therefore provides that in order to value deemed supplies, you look at the cost of supplying these goods or services, and in the absence of the cost, you look at the market value. The executive regulations will provide guidance on how to ascertain the cost or the market value. So far as imports are concerned, in order to ascertain the tax base for determining the import VAT obligations on goods or services, goods being imported into Oman, you would need to refer to the customs value. You would also need to include within the tax base the value of insurance, freight, customs fee, and customs duty that is paid on the imports. And if the goods which are being imported are subject to excise tax, then you would also need to factor that in the tax base before you ascertain your import VAT obligations. So far as re-import of temporary exports is concerned, where businesses have sent goods outside Oman for these to be reworked, whether that's for repairs, refurbishing, and the goods are being brought back, it is only the value addition, which is also recognized as the valuation for the purposes of customs, which would warrant consideration for you to ascertain your import VAT obligations. Moving on to the next slide on registrations. Again, in line with the GCC framework agreement, the Oman VAT law provides for mandatory registrations, which means any business which has over 12 months, and this could be backward looking or forward looking, which means that the month in which the threshold is being looked at and the previous 11 months, or the month in which the threshold is being looked at and the 11 months that would succeed or follow. If the business's value of supply during these 12 collective months is expected to meet or exceed USD 100,000, or in Omani Riyals 38,500 Riyals, then the business is expected or required to obtain a mandatory registration. Similarly, there are also provisions for voluntary registration, where if the value of supplies or expenses over 12 months, again backward looking or forward looking, is expected to fall between 50,000 USD or 100,000 USD, which is 19,250 Omani Riyals to 38,500 Omani Riyals. If it falls between this, and these are annual caps, then the business would be eligible to apply for a voluntary registration. It is not mandatory, it is at the option of the business. In addition to this, the Oman VAT law also makes provisions for non-resident registration. These essentially are relevant for a non-resident business who is effecting supplies in Oman, which are taxable. Now, unlike the mandatory and voluntary registration options, there is no monetary threshold for these, the non-resident registration. As soon as there is an obligation to pay tax, notwithstanding the value, the non-resident business would have to obtain registration in Oman and would have to comply with all the other obligations, whether it's filing of returns, payments of taxes. But in order to fulfill its obligations, the law does allow the non-resident business the option of appointing a tax representative who can act on their behalf. In addition, the law also makes provisions for tax grouping. What a tax grouping essentially means is that two or more companies who satisfy criteria which will be laid out in the executive regulations can, instead of obtaining independent VAT registrations, form a single unified VAT group or tax group. What that would mean is that all the members of the tax group would then appoint a representative entity which would file single returns on behalf of the tax group, interact with the tax authorities for the purposes of assessments and audit, and will be the single liaison point between the tax authority and the business. But what this also means is that all the members of the group would be jointly and severally responsible for the liability of the tax group. Now, the law does not set out the criteria. We are expecting that the executive regulations will. Generally, given our experience in the rest of the region, we've seen that this usually revolves around common shareholding, or it revolves around common management and control, or both. Now, the law also allows businesses exemption from registration, but that's only in case of businesses that are entirely making zero-rated supplies, and that is subject to the approval of the tax authority. Moving on to the next slide, we now discuss the input tax.
Just sorry to interrupt you. I want to give you a break. So the question about the registrations, do we have an idea about when the tax authority would start registering businesses?
So at the moment, the tax authority is aiming at starting the registration process in the month of January, December 2020 or January 2021. It would be an online process. So, yeah.
Okay, that's good to know.
So we were discussing input tax recovery. The VAT law does provide broad provisions on how input tax recovery would work. It allows businesses to deduct or recover eligible input tax up to 3 years from the end of the tax period in which the business's right to deduct the input tax arose. Now, it also makes certain provisions on what input tax cannot be claimed and would have to be expensed off or would be a cost to business. This includes input tax, which is VAT paid on goods or services used to make exempt supplies. It also includes VAT paid on any goods prohibited to be supplied, exported, or imported into Oman. Now, the law is a little liberal in the sense that currently it does allow businesses to claim input tax on goods which are proved to be lost, stolen, damaged, or goods which are used as commercial samples. But we would expect that the executive regulations would put certain criteria or conditions around the quantum of such input tax or the conditions for claiming such input tax. Of course, the law also provides for apportionment. What that means is when you've used goods and services for making supplies which are taxable as well as exempt, you will not be entitled to claim or recover the full input tax credit. In those instances, how do you identify the quantum of input tax that the business is eligible to claim, and how do you forego the rest? So the mechanics of this will be available in the executive regulations. Moving on to the compliances on the next slide. The law does touch upon compliance requirements in the form of documentation, record keeping, returns, as well as refunds. So the law requires every business to issue tax invoices for a taxable supply. The law does not set out the details, but there is certain guidance which has been issued by the tax authority, which gives us an illustrative list of details which need to go on tax invoices. That should help businesses to start document layout and making changes in the systems to make their invoices VAT compliant. But the details certainly would be validated and followed in the executive regulations. It also makes provisions for simplified tax invoices, which are not as detailed, and substitutes to tax invoices, which could be in the form of bank statements or other documents, which could be issued by certain businesses in lieu of tax invoices. But then again, that level of detail is expected to come in the executive regulations. The law recognizes that in certain cases, supplies will be made in foreign currency, but it requires that every invoice would, even if it's for a supply which is made where consideration is received in foreign currency, the amounts would have to be stated in Omani riyals. And in order to convert the foreign currency rates, you would need to rely on the rates published by the central bank on the date of supply. So far as retention of records is concerned, in terms of records related to real estate, you need to keep them for 15 years. All other records would have to be maintained for 10 years. The periodicity of returns hasn't been defined in the law. It will come through likely in the executive regulations, but the law does say that the returns and the payments would be due on the same day and can be made together and would have to be within 30 days from the end of the tax period. A taxable person is allowed to revise returns up to 3 years from the date of submission. The tax authority is also allowed to make adjustments. They have a similar time frame of 3 years, but in instances of fraud, that can extend up to 5 years. The law also lists down instances in which businesses can apply for refunds. These are essentially circumstances where the input tax is in excess of the output liability, refund that can be claimed by tourists, by non-resident, and special bodies identified in the law. Again, every law is incomplete without penalty provisions. So far as the Oman VAT law is concerned, there are 3 categories of penalties. One is late payment penalty, which is percentage based. That is the additional tax which is levied at 1% per month on the amount of tax due. And then there are 2 categories of fixed penalties. One which ranges from 1,000 Omani riyals to 10,000 Omani riyals, along with the provisions for imprisonment for less stringent, for less complex violations. And then there's the most stringent penalties, which range from 5,000 Omani riyals to 20,000 Omani riyals, along with imprisonment for more serious offenses. And where there are penalties, there's tax dispute resolution. So far as the tax dispute resolution mechanism is concerned, it is quite in line with the corporate tax laws in Oman, where the assessment can be done by the tax authority. The tax authority has 5 years usually to complete the assessment. And in instances where a business should have obtained registration but did not, it can extend up to 10 years. An appeal can be filed against the assessment before the head of tax authority. That needs to be filed within 45 days, and the tax authority would then decide upon it within 5 months, which could be extended by 3 more months. An appeal against the objection decision could be filed in the form of a grievance before the tax grievance committee. Again, it needs to be filed in 45 days. And in instances where one wants to appeal against the decision of the tax grievance committee, these appeals would lie before the courts, primary courts, moving on to the Supreme Courts, and again needs to be filed within 45 days of being notified of the decision. And last but not the least, transitional provisions. This is extremely important for businesses, especially where there are contracts which are long-term, which you concluded now or will conclude before implementation of VAT, but will also entail supply of goods or services after VAT. And it's critical because the law is very clear that if the contract does not mention VAT, the consideration is deemed to be inclusive of tax. So if you enter into a contract today, which entails supply of goods or services after the date of implementation of VAT, which is after 16th of April, to the extent the supply was concluded after 16th of April, the supply would be liable to VAT, notwithstanding on whether you've factored it in the consideration or not. That's all from me from now. Back to you, Ashok.
Thank you, Aabha. So that's quite useful. A lot of details in the VAT law, even though the executive regulations are yet to be issued. So certainly businesses can start thinking about how these provisions in the law will impact their businesses. It will be now good to hear from Nick on what he feels are the changes between or differences between the Oman law and the Saudi law, and how Omani business would be considering in relation to some of these differences. So Nick.
Thank you. Good morning, everybody, and thank you all for attending today. I thought I would just highlight a couple of differences and similarities with the Saudi VAT situation. And as Ashok said, there are some kind of key actions which all taxpayers should consider taking as soon as possible as they prepare for the exec regulations to be published. So as Aabha said up front, the law comprises 106 articles, which is literally twice as many articles as the KSA equivalent. It from a definition point of view, it kind of captures a lot of the definitions as outlined in the GCC agreement, rather than refer back to the agreement, which is what the Saudi law does. The Saudi law, I would say, sets more of a framework, whilst the Omani version, I think, gives a lot more detail in terms of some of the principles, as Aabha mentioned earlier on. What's still missing, however, is quite a lot of detail. So you've got a kind of halfway house, which is not ideal. I don't think, because now we've been given a taste of what the regs may say, but we're still waiting for an awful lot of detail, unfortunately, before we can, let's say, finalize our preparations. Aabha's already gone through the various definitions, which is that's in the, I guess, in the law, so there's no doubt. On reading some of the definitions, there are a couple of I think potential areas where there may be some ambiguity, but at least it's pretty clear in the preamble that the law is based on the GCC agreement, so you can always refer back to that. And so my advice to everybody on the call would be not to forget the basis for this law, should there be any ambiguity. Aabha's talked about the right to deduct input tax up to 3 years. There's also a need to maintain records for 10 years. Now, Saudi has the ability for taxpayers to recover VAT up to 5 years. I think Reef will come on to the UAE later on. And the records must be maintained for 6 years. So what's interesting is there's a longer record retention requirement. I'm guessing that matches the income tax law in Oman. And then there's a potential for extending the record keeping requirements up to 15 years for real estate transactions. One of the areas of the definition which hasn't been copied over from the GCC agreement is in terms of capital assets. And we know capital assets, especially in terms of partial exemption and apportionment, it's a really important part of how you calculate how much VAT you're allowed to deduct. That relates to what we call mixed supplied, which is taxable and exempt. And so in Saudi, you've got 6 and 10 years for intangible and tangible assets, with an extension of another potential 5 years, simply for the purposes of managing the record keeping for these assets. So it's kind of in line with Saudi. But what I find interesting is there's no reference that I could see to capital assets. So I'm presuming that's going to come in the exec regulations. And for those businesses which are in financial services, for example, and as Aabha mentioned, making exempt supplies such as residential licensing, leasing, and disposal of bare land, it's going to be an important area to watch out for in the exec regulations. There's the ability to appoint tax agent, same as Saudi, on approval. And here the tax agent, unlike Saudi, kind of steps right into the shoes of the taxpayer. What we found with non-resident registrations, there was an issue there in terms of the onus and the liability placed on the shoulders of the tax agents when supporting registration for non-residents. And that hindered non-residents wanting to register because of the potential risk of their agents, who clearly were concerned about taking this kind of liability on. So that's something which has changed over time in Saudi, and I expect if there's the same reaction in terms of non-resident registrations, that some action will be taken by the authorities in due course to lessen the financial burden. I think Aabha also already mentioned that there is a few kind of time periods missing that have been kind of rehearsed in the law. For example, pre-registration input tax, there's no time period for that, which is unusual. And readjusting input tax, for example, if you haven't settled your invoices from your suppliers, that's also something in the Saudi law, and normally it's a 12-month window. If you don't pay within 12 months, you've got to kind of reverse the input tax. So those, I presume, will be dealt with in the exec regs. Aabha's already mentioned the exemptions. They are broader than in Saudi. Local transport is an interesting exemption. I'm assuming that means taxis and buses. In Saudi, we don't have exemptions for sale of bare undeveloped land. It's going to be really interesting to understand what is classified as undeveloped. For example, if you do the civils, if you proclaim the land so it's ready for building, is that developed or undeveloped? Important to understand, because you could be incurring VAT in preparing the land for sale or construction, and have that VAT denied if the view is that the land that you sell is undeveloped. That's a potential problem, I would imagine. Zero ratings are much broader in the Omani law. Specified food items, that's an interesting one in the sense that trying to understand which food items will be zero rated and justifying the zero rating is going to be a challenge. Those of us who've been in VAT for a long time understand that zero rating sounds good and politically is always something welcomed by residents and citizens, but managing it is a different game altogether, and can be quite complex, and can lead to quite detailed definitions of let's say, a food item, to understand whether it qualifies or doesn't qualify for zero rating. So as much as it sounds like a really good initiative, it does come with its own challenges, to say the least. I quite like this point about taxpayers being able to amend returns within 30 days without penalty. I think that's a really good idea. So it encourages you to check your return post-submit, and make any changes necessary on obviously the next return, or potentially, going back and reversing and changing the return just submitted. But I think it's a great idea so that taxpayers are given a chance to fix things before the penalties start kicking in. There is a restriction in terms of how long you can still amend returns post initial submission, which is interesting because Saudi doesn't have that restriction, and also Saudi doesn't have this 30-day hiatus, which, as I said, I think is a great idea. Next slide, please. Excuse me. Much like Saudi and the GCC agreement, there's an ability to refund tax to foreign governments, non-residents, tourists. There's an interesting article, or part of the article, which deals with refunds, which gives the head of the tax authority the discretion to refund tax in cases which are not necessarily directly covered by the legislation. So there's kind of a catch-all, very wide discretion, which I think, again, could lead to distortions if not managed in a fairly restricted and exceptional way. But that, in some ways, is not a bad thing. provided their rules which manage how that discretion can be applied. We don't have that discretion in Saudi Arabia. I've already talked about objections. Saudi has a 30-day limit before by which time you have to object to decisions. What I found interesting is the length of time in Oman that the authority has to respond. In total, it could be up to 240 days. And if there's no response at the end of that time, then the taxpayer treats that as a rejection. So it's a really long time to wait before you kind of maybe understand there's a rejection. What I think is a little disappointing is there's no onus really on the tax authorities to respond. And I think it's tough if you get a response, so you deem it to be a rejection, but you don't know why there's a rejection. Then how do you appeal if you don't know the kind of grounds for the rejection? I think there's a flaw in the process there, which probably needs to be attended to. The grievance committee, I like the idea of this because it comprises tax officials, i.e. employees of the authority, and non-employees of the authority. So at least you may get some non-tax authority views thrown into the mix. Opens up the opportunity, I presume, for lawyers and maybe senior tax professionals to be part of these decisions. So we get a bit of more expertise into the process, which I think is always welcome. And then there's a competent primary court if you can't get past the grievance committee, which is part of the normal court process in Oman. Again, the challenge will be to what extent they'll be technically experienced, or let's say even competent people sitting on the primary court. But that's a development issue over time, or the expertise around these court decisions will just improve. Penalty provisions broadly in line with KSA, nothing kind of exceptional there. Transitional provisions are very, very simple. Prepayments will not advance the time of supply, again, much like Saudi. What I find interesting is no grandfathering for contracts entered into before the implementation date. So basically every supply which is made after 16th of April will be subject to VAT. That might be a problem for some of the government entities, which is what we found in KSA, and it caused an awful lot of difficulty in terms of contracts which were already signed and sealed. And now there's an extra cost in there, and there's been a kind of constant battle between the suppliers and government entities in terms of who shares that, or how that burden is shared rather, and who pays. An interesting clause just to end off this session, which I want to highlight, was this clause which says you cannot transfer your tax burden to another taxpayer, which to people like me is fairly straightforward, but sometimes taxpayers, especially where the tax is new, don't realize that that is not something which is possible. So that's me. Back to you, Ashok, if you want to press on with this.
Yeah,
you're welcome.
Thank you, Nick. Just one clarification. You did rightly point out that as far as the objection process is concerned, the law states that if the tax authority does not provide a response, then it is deemed to be rejected. Unfortunately, that has been the case not only in this new VAT law, but also in the corporate income tax law for a number of years. So this is something which taxpayers in Oman are used to, but in practice, they do. I'm not aware of any single instance where the tax authority has not responded. So I think they fully understand their obligations to respond in a timely manner.
Thank you.
Now, I think it will be good. That Saudi is an important sort of country, and when we need to sort of benchmarks to see what are the differences between Oman and Saudi Arabia. But UAE is another important sort of neighbor for Oman, and it will be good to see from Rees what are the key features or what are the key differences.
Thank you, Ashok, and thank you, Nick and Aabha. As sort of touched on by Nick, it's hardly surprising that the VAT law in the UAE, where I am, and Oman are very similar. One, because VATs around the world tend to be very similar, and of course, with the GCC framework. One wouldn't expect too many variations. Nick has called out some of the key ones, which are perhaps common to both UAE and Saudi, as opposed to the new Oman law. So what I thought I might do is pick out some of the policy decisions that are sitting behind some of these key differences, because they're kind of, in many respects, based on the position in other jurisdictions. So I thought I might just call some of those out and share some observations on how some of the issues have played out in other jurisdictions, Australia in my case, but also the EU for others. So the first one I just wanted to touch on, and I noticed that in the chat box we had a question around this, which I'll try to address, around the 3-year rule, as I like to call it, for carrying forward input tax. Now, as Aabha has pointed out, the way a VAT works is that if you buy goods or services to use in your business for the purposes of making a taxable supply, standard rate or zero rate taxable supply, you can claim back the input tax as a deduction. In the UAE, you can do that in the tax period, which is most likely a calendar month or a calendar quarter, the tax period in which you incur the expense, to keep it very simply, or the next one. So you only get 2 tax periods in order to claim. So if you don't claim the input tax in the return for period 1 or period 2, then you have to come back and amend those returns in the future if you wish to subsequently claim it. Whereas here under the Oman law, you have 3 years. So if you have an input expense referable to, say, June of 2021, then you have out until May of 2024 in order to claim that input. You don't need to come back and amend if you don't wish. Amend the returns have been filed. What that gives you is a lot more flexibility. If you're unclear, for instance, whether you're entitled to claim the input or not, then you've got a much larger time to give it considered thought. And then maybe from a tax risk management point of view, you consider, well, look, I won't claim it now. I'll spend the next month or 2 doing some research, getting some advice, and then in 3 months' time, I can claim it then. The importance of that is, of course, you're not taking risk by being time pressured into making a claim you may not be entitled to, but equally, you don't need to go back and amend to subsequently claim something if you decided that you do have an entitlement. It gives you a lot more flexibility than we certainly have here in the UAE, where you have 2 months or maybe 2 quarters to make a decision and act on it. It also, from a practical point of view, gives you a lot more flexibility if your accounts processing procedures and systems are a little bit slow, because invariably, certainly here in the UAE, the 2-month or 2-quarter period runs from the date on which you receive the invoice. So from a VAT compliance and reporting point of view, we're really reliant on accounts payable being efficient. With a 3-year period, you've got a lot more leeway for that to work its way through the system. The other one, and Nick pointed out that there is an exemption in Oman for healthcare and education services and related goods and services. That's important for those operators, because certainly here in UAE and in most countries around the world, health and education are what are called zero rated, which means there's no tax on the income that you receive or the supplies that you make, but you can claim back all of your input on your costs in full. So in most countries, certainly UAE, healthcare and education gets full input recovery. In Oman, because it's exempt, broadly speaking, the input is not recoverable. So you'll have a VAT cost, if you like, or an indirect VAT cost on your expenses, which you'll need to build into your cost structure. But as Nick pointed out, then how one ascertains what input can be claimed in what proportions is a very complex measure. Aabha touched on that the second or subsequent resale of residential property will be exempt, but most likely on our reading of the law, the first sale will be taxable, standard rated at 5. In the UAE, it's 0 rated. What that means then is that will have an impact on either pricing into the market, because developers will need to include a VAT cost in their pricing, or a hit to developers' margins, because if the market rate won't move, because that's just the market price for a house, then the VAT needs to come out of the developer margin. So there's a very keen pricing decision to be made for developers around that. That's the Australian position, so it's a really well understood thing, but we need to get that VAT cost and its timing in the development feasibility for developers. Nick touched on zero rating for food items. This is very familiar to me because in Australia, what I'm calling basic or fresh food is zero rated, while processed food, more luxury items, candies, chocolates, those kind of things are subject to VAT. And classification of food is really hard because it's very easy to say that an apple, for instance, is fresh food and should be zero rated. Bakery products and things become much more difficult around where is the line drawn and how does one change? And as recently as 2 weeks ago, there was a case in Ireland, which has had VAT for 40 odd years, 50 odd years, where there was an argument in the court about whether a particular sandwich loaf, bread for sandwiches, was bread or was it a bakery product, and it came down to what was the sugar content. So even in countries that have had this distinction for 50 years, we're still fighting around the margins. So if you're in the food industry business, food classification is tough, and we do a lot of work with our clients around getting the category lines properly identified. Maybe just the last one to touch on is a welcome introduction or difference in Oman as opposed to UAE, is the definition of a taxable person expressly includes for Oman some joint ventures and some partnerships. That's important because they're essentially therefore treated as a person and a taxpayer in their own regard, separate and distinct from their underlying participants. It's a very unclear area of the UAE law here as to how one deals with JVs and partnerships, whether it is the collective JV or partnership vehicle which should comply with the tax, or should those compliance obligations be pushed down to the individual participants, and that comes around to the definition. So I think it's a very welcome thing because it'll allow you to treat a JV or a partnership as an entity separate and distinct from the participants. Ashok, I perhaps will leave it there and hand back to you.
Thank you, Rees. So before we go to the questions, and a number of questions have been raised, I would request Aabha to close out by pointing out what are the next important steps businesses should be taking even before the executive regulations are issued.
Sure. Thanks, Ashok. So I think it's very clear that VAT impacts all facets of business. It's a business transformation project. It's not a finance or a tax project. So businesses need to look at every part of their operation to be VAT ready. Now, with only 6 months ahead of us, you should already be planning around areas of procurement, sales, finance, IT, and the ones that are usually the last to be involved, which is legal and human resources. So start looking at your vendor pricing, vendor selection policies on whether you would want to buy only from VAT registered vendors or unregistered vendors too. And you want to look at your AP processing to make sure that you don't lose any input tax credit because of non-compliant invoices or for the want of making payments to your vendors. And you have as much skin in the game when your vendor education and communication is concerned, because unless they are compliant, unless they don't issue compliant tax invoices to you, you will not be in a position to claim input tax credit. So you have vested interest. Sales teams and marketing teams, it's critical that they start looking at pricing with customer contracts if they haven't already. For the contracts which are long-term, for reasons mentioned earlier when we were discussing transitional provisions, it's important that you start looking at VAT clauses, start negotiations with customers if you haven't already. Some of these contracts may have change in law clauses, but you need to look at contracts to know whether you need to make any amendments or not. Marketing schemes, labels, etc., and customer education to make sure that your frontline staff is able to communicate why you're recovering VAT and recover it. Because if you are unable to recover VAT from your customers, that dents your profitability. So far as finance is concerned, the usual compliances, returns, but in addition to that, as a measure towards planning, you also need to look at the overall financial impact on the business. How is it going to impact your working capital? How is it going to impact your profitability? And plan around it, given that you have time. Now, IT is the backbone of all of this. So you will need to start looking at the gap system configurations, cleaning up masters, master updates, making sure that the documents, whether it's the tax invoice, simplified invoice, any document in lieu of a tax invoice is appropriately configured in the systems and is compliant, and make sure that you also have the appropriate reports coming out of your systems to make sure that the returns are filed on a timely basis and accurately, because the penalties could be stringent. And at the end of the day, you also need to make sure that while you have all these reports and documents, you also archive them and make sure that you comply with the timelines specified by the tax authority. Legal is extremely critical for contract negotiations as well as representations to the tax authority. Unlike the UAE and KSA, we do not have a process for advance rulings or clarification requests. Any issues that you want to raise with the tax authority would have to be by way of representations, whether you do them collectively through a body or independently, but you will need to start engaging in discussions with the tax authority given the time on hand. And HR, given that deemed supplies could have certain impact on employer-employee transactions, you will need to look at policies, you will need to look at allowances and claims, which is the VAT impacted part, but at the same time, you would also need to look at your staffing and training requirements to make sure that the team that you have to deal with the VAT implementation as well as post-implementation is reasonably equipped to make sure that the transition is as smooth as it can be. Moving on to the next slide, things that businesses should certainly be looking at. Having a plan, making sure that roles and responsibilities are clearly defined, the implementation timelines are clearly defined, the governance structure is clearly defined, and having a communication strategy for internal as well as external stakeholders, making sure that you onboard different stakeholders now so that everybody is able to gauge the kind of impact VAT is going to have on their operations and shoulder the responsibility collectively instead of this becoming eventually a tax or a finance function. In order for you to be able to ascertain the impact of VAT, you do not need to wait for the executive regulations. For most industries, the law is reasonably detailed for you to be able to do a lot of groundwork, which you should clearly be looking at transaction mapping. Because it's a transaction tax, you need to list down all your transactions, supplies, purchases, employer-employee transactions, and see how VAT impacts each of these transactions. The financial impact, look at contracts, look at training and staffing to make sure that you're planning for the future and not for the present. Look at the processes where there are VAT touch points and make sure that if it requires any changes in the process or in the systems, they are taken care of, and make sure that there is also a follow-on compliance and risk control framework review. And while you're doing all of that, and that helps you ascertain the impact VAT has, in order for you to be able to make sure that you meet your compliance obligations, you need to have a IT system which supports the entire transition. So it's critical that you start with the IT impact assessment, look at the business requirement documents, solution design documents, engage in discussions with your vendors for the time they would need to make sure system configurations are in place, start cleaning your masters, vendor masters, customer masters, and once this is clear, the executive regulations or the guidance is out, and there is enough detail for you to look at what goes on into a tax invoice, what goes on into a credit note, make sure that you do the output testing. You can do this on the basis of the law to the extent that there are gaps between the law, which the law doesn't answer. You will have the executive regulations or guidance come in. You can revalidate this at that point in time instead of starting the exercise from scratch at a later point in time. And while you plan for this, you also need to keep an eye out for the registration portal when it opens, and during the entire process, make sure that you communicate with your stakeholders through internally and externally, and then prepare for go live. What you need to do immediately though, and if you were to break the next 6 months into parts, is if we move on to the next slide, we've had the law issued on the 18th of October. If we were to look at a milestone of 3 months with or without the executive regulations, you can certainly go through the journey from now until then and get ready with the preparations, understand the tax positions on your transactions, assess the impact on business in terms of profitability as well as working capital, identify issues that you need to represent to the tax authority, review your contracts, assess the impact on your ERP or accounting systems, have a plan for the cutover strategy or the transition strategy, especially given that VAT is going to be implemented from 16th of April, right in the middle of the month, and make sure that you prioritize mission critical items. As soon as the executive regulations or the guides are out, you can do the revalidation, but at least you've done the groundwork. You cannot wait for any more information to be issued by the tax authority because that will come in a phased manner and you don't have enough time. That's it for me. I think we can move to the question and answers now.
Yeah. Thank you, Aabha. So one question which has been raised by many is, are we going to share this presentation? The answer is yes, we will do that. Now, there are a number of questions. We won't be able to address all of them, but I will try and make sure that in the next 10 minutes, 15 minutes, it will go beyond the scheduled time of 12:15. But given the extent of interest and the number of questions, we'll try and address for the next 15 minutes. So the first question is probably for Rees. There has been a question on financial services. Clearly, the law does not define what the financial services are, and the question relates to, are insurance companies likely to be exempted? Would that fall within financial services?
Yeah, thank you, Ashok, and thank you for the question. I mean, as a general, let me rewind that. So the law simply says at the moment that financial services are exempt, but it's those financial services which will be specified in the regulations. So we need to wait for the executive regulations to come, hopefully in the next few months. As a general proposition, certainly in UAE and in other jurisdictions, life insurance is generally VAT exempt, whereas other forms of insurance, health, general insurance, commercial, directors insurance, and so forth, is subject to VAT at the standard rate. So my expectation is that Oman would follow that proposition. So life would probably be exempt, everything else probably standard rate. And then, of course, one then has the complication of, if it is cross-border, whether the zero rating exporting rules, for instance, come into play as well.
Okay, one follow-up question.
Just to add to what Rees has said, the tax authority has just recently issued some informal information sheets, and in that there is a mention of life insurance, as Rees said, being exempt. So
yeah, thank you. And one follow-up question for Rees relating to the insurance business. If will there be VAT on the unexpired period of an insurance contract, even though the contract has been issued prior to the implementation of VAT law? This links with the transitional provisions which Aabha went through.
Yeah. So if you have a year-long premium who still has a tail left to run come April of next year, will that tail be subject to VAT? Is the question. Aabha, I might pass to you because I don't think that's an insurance question. I think that's more a transition provision. But I know, as you were saying, the rules are very, very clear and simple.
Sure. So if we look at the transition rules, the way they look right now, it does provide for levy of VAT on supplies which are made partially prior to VAT implementation and after VAT implementation. So to the extent the supply of insurance services relates to a period after 16th of April 2021, although you've entered into the contract now, you've issued a policy now, you've probably even collected an annual premium now, those would be liable to VAT.
Thank you. Rees,
Ashok, just want to make a quick point there. So following on from the points that Aabha just made, the issue is there if you have unearned revenue as at the end or at the 15th of April, I guess, or the day before implementation, you will have to, like in Saudi, almost certainly account for VAT on that unearned revenue. And the problem with that is you will not have necessarily built in a VAT amount into that balance.
Exactly.
So what happened? Yeah. So what happened in Saudi was that there was a kind of, unfortunately, a kind of quite significant amount of VAT which then had to be paid and came out of profits. So it's a really important point because it did have an impact on the market, and there was a lot of churn as a result of this cost, because you can't pass it on, and those insurance companies that try to pass it on obviously upset some of their customers. So that's the consequence of if you like, the VAT coming in, and no transitional kind of cover for this particular matter.
Right. Nick, the next question I could possibly give it to you, and this question is general, not any sector specific. The question is it advisable that related parties should form a tax group? Aabha mentioned that there are provisions on the VAT law saying that related party transactions should be properly valued. Maybe it's a question arising on account of that. So what are the considerations for VAT grouping?
My view is always that I think a VAT group makes more sense than not having a VAT group. Some businesses or groups want to keep their let's say their market coverage separate, so they won't necessarily have all the businesses in the group within a single VAT group. So there are always reasons of that nature, commercial reasons why you might not want to do it. But my view is it simplifies VAT accounting, it reduces risk. Yes, there's some admin to put in place around managing what we would call dummy returns within the group, so that there's one consolidation at the end of the period for submission to the tax authority. But in my view, it's almost always a win where you have lots of transactions between group members, and where those transactions may be at different rates, potentially exempt and taxable. So I would urge all of the groups to seriously consider forming a tax group for the reasons mentioned. Downside is obviously you've got joint liability, but that again becomes more of a commercial issue, and ensuring that whatever liabilities may arise are let's say the responsibility is equally shared amongst group members.
Yes, and in fact, that's where the control is also equally important. Who are the people who are shareholders of that group? If there are external shareholders, you may think about whether that group should be formed. Thank you, Nick. The next question, Aabha, is for you. This is something which we briefly discussed yesterday, and it relates to the power generation. I think there has been some speculation that is power generation exempt from VAT. What are your thoughts on this? And if VAT is applicable on power generation, then the question is, will it apply on the fuel charge income, as the supply of natural gas would be zero rated in the eyes of the person raising the question?
Sure. So, so far as the tax treatment of power and utilities is concerned, we've gone through the list of transactions which are specifically exempt and zero rated, and supply of power does not fall in these, and therefore the logical assumption therefore would be it should be standard rated and liable to tax at 5%. Otherwise, it would have been called out as an exception. To your second question on whether there would be a VAT which would apply to supply of fuel, again, like I said earlier, it will be what we have right now in the law is a zero rating which is given to crude oil derivatives, and natural gas. It will be critical to look at what kind of natural gas is being supplied, because often whether it is liquefied natural gas or natural gas in a different form. So what is the form in which the gas is actually being supplied, versus how do the executive regulations or law look at what falls within the scope of natural gas for us to determine whether the supply of natural gas in exchange for fuel charges would be zero rated or would be standard rated.
Okay. The next question is on deemed supplies, and maybe Reese, you can have a go at this. The question is, how would value of deemed supplies be determined? And as an example, they're talking of sublease of property with no rent being charged.
Thank you. And so, Aabha, I know that you did touch on this in one of your slides, but I mean, broadly speaking, you come up the deemed supply rules. Broadly speaking, give you there are two rules for determining the value. A, it is the cost, or it's based on the cost of the thing that you purchase and on supply. And to the extent that that is not available or reasonable, then it's a market value substitution. And so that cost rule, if I may call it that, is a reasonably straightforward one to use, where one buys goods and then provides it to a related party or to an employee or so forth, because you can very precisely pinpoint the cost of the thing that you are supplying. But in many instances, it's particularly with relation to services and other things, that's just not possible, and so one would default to market value.
Thank you. Nick, next question to you, please. Educational services. We don't have the definition, but the question is, would it include housing, hostel facilities provided to students against monthly fees or monthly rentals?
Gosh, that's a wicked question. Thanks, Ashok. In some parts of the world, provision of dorm facilities, which are residential, in nature for students, would certainly be treated as part of education, or in this case, because the supply of essentially long-term accommodation is exempt, I think you can safely say it would fall within an exemption, either as a supply of residential accommodation or a supply of educational services. The kind of concern would then be to what types of educational services fall within the exemption. So, for example, courses which are not part of a kind of core curriculum in some countries fall outside of the exemption for education. Courses which are provided, let's say, by business schools or by non-accredited institutions or registered institutions with the educational authority could well be taxable. So again, it's really important to ensure there's good clarity on what an educational institution or what an educational service could be. Private gardens or creches or indeed private schools could fall outside of that. And that's where the risk comes, because there could be significant input tax incurred on building, maintenance, consumables, which then gets fed into the school fees, and that cost is essentially hidden, but definitely felt by the consumer. Hopefully that answers the question.
Thank you. Aabha, would supply of goods, services to a government institution be exempt?
So at the moment, if we look at the law, it does not make exceptions to supplies that are made to government institutions. So only by virtue of the customer being a government entity, it seems unlikely that the transaction would accord any different treatment. If it's normally a standard rated transaction, it would attract a tax of 5%. The status of the customer would be of limited relevance.
Right. Yes, I think I would expect that to be the position. A question on.
Ashok, sorry, it's Reese here. Some experience from the UAE. We experienced quite a lot of pushback from government customers, where our clients were selling things to them and wanting to charge VAT, and the government customer was saying, no, we're not. You don't charge tax to the government. It's clearly a design feature of VAT that, yes, you do charge VAT when you sell things to government. And then it's a question for the relevant government authority or department to seek a refund through that mechanism. So there's an education process. If you're dealing significantly with government, there's an education process you need to start saying we are going to be charging you VAT, but you will be entitled to claim it back through that process. So it's important to get on the front foot with your customers.
Okay. Yeah. Fair point. Aabha, record keeping. Can records be kept in soft copy form?
Right. So so the law requires you to maintain the records in a secure form. Currently, from the preliminary reading of the law, we don't see specific mention of maintaining them in an electronic form, but it doesn't reject the idea of maintaining them in electronic form either. So given that we are moving towards a paperless world, I would expect that the executive regulations would, in some shape and form, validate that electronic records can be maintained. Having said that, at the moment, the law does not require you to categorically maintain manual records. So my reading would be that yes, you should be allowed to maintain electronic records so long as they are secure and accurate.
Right.
Just a point on that. Well, I don't know if Oman has any legislation around digital
There is
digital economy. So it might well be, sorry, Ashok, that there are references to what extent digital information is valid and provided it's secure, whether it's in a local server or encrypted or whatever, it can still be treated as a valid document. So you might be able to rely on that in the absence of any kind of further clarity from the tax authority. Sorry, Ashok, you were going to say.
Right. No problem. I think we will take questions, probably one or two more questions. We'll try and close at 12:30. Nick, you may try to respond to this question. Oman has a free trade agreement with the US. So, imports from the US are not attracting customs duty. The question raised is what would apply to VAT?
Right. So when reading through the law, customs duty doesn't drive the VAT treatment.
Correct.
So you'd have to look at to what extent the items are either exempted from VAT as per the list in the law or zero rated. And on that basis, that's how you determine whether import VAT would be due at the time of clearance. Certainly, items which are exempted from duty, depending on their nature, may also be exempted from VAT. But as I said, you're going to have to look at that from a VAT point of view rather than a customs duty point of view.
Just to add to what Nick said, the US Oman FTA provides for an exemption for import of goods, not so much a suspension or a zero rating. So again, depending on what kind of goods are being brought in, unless they are specifically exempt or zero rated for the purposes of VAT, they would in all probability attract an import VAT.
Right. Okay. I think final question, obviously, we can't address all of them and we will try and respond after the webinar is over. So final question to Aabha, and this is regarding the invoicing requirements. Is a retailer required to show the final retail price for a consumer inclusive of VAT, or can it be added at the end of the invoice?
So let me address this in two ways. One is the price that you advertise and the price that you put on the invoice. The price that you advertise, the VAT law requires that when you're selling it, you need to show, in case of certain transactions, on an inclusive basis. But that's the advertised price. So far as the invoicing is concerned, if you look at the guidance that is available in the law, it only talks about issuing a tax invoice. It doesn't give you the details of what should go on a tax invoice. That kind of information usually comes through in the executive regulations. Having said that, in the information sheet that has been put out by the tax authority, they have said that you need to show the VAT amount separately, the value of the supply separately, and again on a line item basis, and then the total amount due. But when this is in the context of a detailed tax invoice. Depending on what kind of business you are in, you may also qualify for issuance of simplified tax invoices. And the simplified tax invoices, subject to you meeting the criteria for issuing the simplified tax invoices, may require much fewer details and may allow you this relaxation. But that's something that we'll have to see once the executive regulations are out. If you're looking at configuring your documents or your systems for you to issue documents today, you would rather configure them with all the details which have been required for a tax invoice. In the future, should you qualify for a simplified tax invoice, you can then issue one instead of having to do the work at that point in time.
Thank you. Thank you, Aabha, Nick, and Reese. That was really insightful. We can go on for probably several hours, but the time has come to say thank you to also the participants who have been throughout the seminar, throughout the webinar with us. So we will send the copy of the presentation, and I'm sure there will be a number of questions which could be separately addressed with each one of you. Thank you once again for attending.
Thank you, everybody. Thanks for your patience.